Part 1. What is Freddie Mac? To understand the fraud, you first need to understand what Freddie Mac actually is. Because most people have no idea. Freddie Mac isn't a bank. It doesn't give you a mortgage. What it does is buy mortgages from banks, bundle them together, and sell them to investors as securities. This keeps cash flowing through the housing market so banks can keep lending. Congress created Freddie Mac in 1970. It's a government-sponsored enterprise, meaning it has an implicit backing from the U.S. government. Investors around the world treated Freddie Mac like it was essentially risk-free. It had an AAA reputation, a seat at the table with Wall Street giants, and by the early 2000s, it was one of the most powerful financial institutions on the planet. It also had a massive secret. Part 2. The fraud. By the late 1990s, Freddie Mac's executives had a problem. The mortgage business is volatile. Interest rates move, prepayments spike, and earnings can swing wildly from quarter to quarter. Wall Street hates volatility. Analysts want steady, predictable growth. And Freddie Mac's leadership wanted to look like exactly that. Smooth, steady, reliable. So they cooked the books. Starting as early as 1998, Freddie Mac began manipulating its earnings through improper accounting of derivatives and financial reserves. They understated profits in good years and stashed the excess in reserve accounts, essentially a rainy day fund they could tap later to top up earnings during leaner quarters. They were literally hoarding profits to dole out on a schedule that pleased Wall Street analysts. The SEC would later call it a fraudulent scheme that deceived investors about Freddie Mac's true performance, profitability, and growth trends. The total misstatement? $5 billion across 2000, 2001, and 2002. And the kicker? They weren't even inflating earnings the way Enron did. They were mostly understating them, which tells you everything. They weren't trying to look bigger than they were. They were trying to look steadier. They were manufacturing a fake image of stability at one of the most systemically important financial institutions in the country. Part 3. The Unraveling. In early 2003, Freddie Mac's own board hired an outside law firm to review the company's accounting. What they found was bad enough that on June 9, 2003, the company fired its top 3 executives: CEO Leland Brenzel, President David Glenn, and CFO Vaughn Clark, all in a single day. The stock dropped immediately. Analysts started calling it the next Enron. Congress started asking questions. When the full restatement came out in November 2003, Freddie Mac restated $5 billion in earnings going back 3 years. The Office of Federal Housing Enterprise Oversight called it management misconduct. Freddie Mac paid a then-record $125 million fine and settled. No executives went to prison. CEO Brenzel eventually paid back $10.5 million in compensation and paid a $2.5 million personal fine. The company admitted no wrongdoing. The story should have ended there. It didn't. Part 4. Round 2. The subprime lie. By 2007, Freddie Mac had a new CEO, Richard Siren, and a new crisis brewing. The subprime mortgage market was exploding. Freddie Mac was buying up risky mortgage-backed securities at a staggering pace. Here's what Siren and his executives told investors. Freddie Mac had between $2 billion and $6 billion in exposure to subprime loans. Manageable, under control. Nothing to worry about. Here's the truth. The actual exposure was $141 billion, and it grew to $244 billion by June 2008. They had lied about their subprime exposure by a factor of more than 40. When the housing market collapsed in 2008, Freddie Mac lost $50 billion in a single year. The U.S. government had no choice. On September 7, 2008, the federal government placed Freddie Mac and its twin Fannie Mae into conservatorship, essentially a government takeover. The bailout cost taxpayers $187 billion between the two companies. Part 5. The insult. Now here's the part that should make you furious. After the bailout, after $187 billion in taxpayer money, after the housing market collapse that wiped out millions of American families, Freddie Mac executives were still collecting bonuses. In 2010, the top 5 Freddie Mac executives were paid $6.46 million in bonuses. While the company was still drawing on taxpayer funds, the CEO alone took home $2.3 million. A bipartisan group of 60 U.S. senators wrote a letter demanding it stop. Congress held hearings. The regulator defended the bonuses, saying they needed to attract qualified executives to run a company the government already owned, with taxpayer money. That had just committed fraud, twice. The SEC eventually sued Siren and 2 other executives in 2011 for the subprime lies. They settled in 2015, without admitting wrongdoing. Part 6. Why it matters. Freddie Mac isn't just a story about accounting fraud. It's a story about what happens when an institution is too big, too connected, and too government-adjacent to face real consequences. Enron executives went to prison. WorldCom's CEO got 25 years. But Freddie Mac, which helped trigger the worst financial crisis since the Great Depression, paid fines, settled charges, and kept the lights on with your money. The people who built the fraud retired. The people who lied about the subprime exposure settled. And the company still exists today, still backed by the federal government, still buying mortgages, still too big to fail. $5 billion in fake earnings, $141 billion in hidden risk, $187 billion bailout, and not a single executive spent a day in prison. That's Freddie Mac. If you want more stories about the frauds Wall Street would rather you forget, subscribe to the Case Study Lab. New video every week.